Welcome to today's finance video. Today we're diving into a topic that affects almost everyone at some point: pension funds. Millions of people rely on these funds to grow their money over decades, ensuring a steady income when they retire. But what exactly is a pension fund, and how does it work? In this video, we'll break down the types of pension funds, how they invest, and why understanding them can make a big difference for your financial future. At its core, a pension fund is a pool of money collected from employees and, often, employers, which is then invested to provide retirement income. Unlike a regular savings account, pension funds invest the money in a variety of assets, like stocks, bonds, real estate, and sometimes alternative investments, with the goal of growing the fund over many years. This allows retirees to receive payments during retirement, even if they no longer earn a regular salary. Essentially, pension funds are long-term investment vehicles designed to provide security in old age. The purpose of pension funds is simple. They ensure that people have a predictable income after they stop working. Many people cannot rely on personal savings alone to fund decades of retirement. Pension funds pool resources from thousands, sometimes millions, of participants, allowing the money to grow more effectively through professional investment management and diversification. By spreading risk across many investors and assets, pension funds help protect retirees from market volatility while aiming for steady growth. The first type is the defined benefit fund. This is what many think of as a traditional pension. In a DB plan, your retirement income is guaranteed based on a formula, usually your final salary and years of service. For example, a formula might be 2% times years worked times final salary. So, if you worked 30 years with a final salary of $50,000, your annual pension would be $30,000. The employer is responsible for funding the plan and covering any investment shortfalls. This means the employer carries the investment risk, not the employee. Next, we have defined contribution funds, which are increasingly common worldwide. Examples include 401k plans in the US. In a DC plan, the contributions are fixed, but the retirement payout depends on how the investments perform. Both employees and employers may contribute. In some plans, the employer will pay 50% of what the employee is investing or even a fixed amount, but the investment risk is carried by the employee. This means that the growth of your retirement fund depends on market returns, asset allocation, and investment choices. The earlier you start contributing, the more time your money has to grow through compounding. If the market is rising and economy is growing, you'll get more money back. But if the market goes down, you will get less. The big difference is that in this fund, the risk is carried by the employee. Next, we have hybrids. These pension funds are combining elements of both DB and DC plans. They might guarantee a minimum pension while still allowing participants to benefit from market growth. Hybrid plans aim to balance security with growth potential, reducing risk for employees while still offering upside from investments. Pension funds invest in a wide range of assets to diversify risk and maximize returns. Common categories include equities/stocks for long-term growth, bonds/fixed income for stability and predictable income, real estate, adding diversification, alternative investments, private equity, hedge funds, commodities. By spreading investments across these asset classes, pension funds reduce the risk of losing money while aiming for steady growth over decades. Diversification is a key principle in pension fund investing. Imagine you are putting all your eggs into a single basket. If this basket drops, all your eggs will be broken. If you put every single egg into a different basket and one basket falls down, you still have all the other eggs left. The same goes with your money in the stock. Rather than putting all the money into a single stock or asset class, funds spread it across many types of investments. This helps protect against market volatility. For example, if the stock market drops, gains in bonds or real estate can help offset losses, keeping the fund on track to meet its obligations to retirees. To summarize, 1. Pension funds are long-term investment pools designed to provide retirement income. 2. There are different types, including defined benefit, defined contribution, and hybrid funds, each with different risk and payout structures. 3. Diversification and long-term investing are crucial to ensure the fund can meet future obligations. Thanks for watching. Pension funds may seem complex, but breaking them down shows how they protect and grow your money for retirement. If you found this video helpful, hit like and subscribe for more finance tips, and stay tuned for our next daily dose of trading and investment advice.